Hello guys and welcome again to my channel. So in this particular video, we're gonna talk about shareholders equity and the accounting for shareholders equity. Okay? But first, let me give you a simple knowledge about this. Shareholders equity is actually related to corporations. So corporations are just business organization that is much more formal. It's because it is established by getting approval from the Securities Exchange Commission. Okay? So it's an artificial being actually and much formal than the sole proprietorship and the partnership, because the sole proprietorship and partnership will eventually be existing based on the agreement of the partners, and if the sole proprietor wanted to make a business of his own, immediately it will be born immediately, the sole proprietorship and the partnership. Here, the corporation, not the shareholders equity, the corporation will just be born if ever the Securities Exchange Commission gives you a certificate of registration. Okay? This is an artificial being, the corporation. It can own assets just like us. It can avail for loans just like us. However, the formalities of corporations, I guess it will be discussed in law subjects. Okay? What we are here to do, straightforward, is the accounting for the shareholders' equity. Okay? So, actually, you have already been learning this A is equal to L plus C. So that is true with a lot of organizations like sole proprietorship, partnership, as well as corporations. Because actually, shareholders' equity is the capital for corporation. So it's like this. A is equal to L plus C, or shareholders' equity. Okay? And I have told you, or you might have already learned this before going to here, that the capital is affected by, first, investment from owners. Okay? Second, it will also change. It will be added if there is a profit or revenues. So in my earlier videos, I talked about revenues first as the ones that will change the capital. But later on, we change that to profit as we go to the higher level of accounting knowledge. Profit is already the summary of revenues minus expenses. And in this case, since there is a profit, that meant the revenues are greater than the expenses. Okay? So, investment from owners, profit, and it will be deducted by withdrawals by the owners, and it will be deducted if ever there is a loss. But earlier, I told you that it will be deducted by expenses also. Which is again, those are still valid. The revenues minus expenses, if ever the expenses are greater, it will result to loss. Basically, if you add the investment from owners plus revenues minus withdrawals minus expenses, it's the same with investment from owners plus profit minus withdrawals minus loss. Actually, the substance is the same because again, profit and loss are the summary of revenues and expenses. Okay? So, that is the simple analysis of the account capital. Is it true here? Yes, it's still true in the shareholders' equity. However, it's much technical. Okay? Like for example, if we talk about investment, normally in the sole proprietorship and the partnership, is that Mr. A contributed 100,000 cash from personal accounts. So the entry will become cash, 100,000, and A capital. It's as easy as that. It's very relatable, right? However, here in the shareholders' equity, it's not like that. Here, it will become like this. Mr. A purchased 10,000 shares at 10 each from BBG Corporation. And then there's this par value. Par value is 5 pesos a share. But the substance of that one is the same with this one. Instead of Mr. A contributed 100,000 from his personal account or cash from his personal account, it will become like this. Sometimes it will be BBG Corporation issued or sold 10,000 shares at 10 each. The par value is 5 a share. Okay? So before we analyze, guys, this one, actually, a corporation, if this is a corporation, it's because the corporations are intangible also, just like businesses. A an ownership of the corporation, if you look it, if you look at it like this, it will be subdivided into shares. So imagine a pizza, because I'm really hungry right now. Imagine a pizza. One slice is one share. Okay? So this 10,000 shares is 10,000 slices. And it depends also, the ownership percentage is also based on the number of shares that um, you are, what do you call this? That you are buying. Buying actually. So for example, if the corporation has an authorized number of shares from the Securities Exchange Commission, 100,000, and you paid for and you bought 10,000, then that means you are a 10% owner. Okay? So, the authorized number of shares that is being applied to the Securities Exchange Commission and approved later on by the Securities Exchange Commission is the number of shares that you can sell if you are the corporation. So, your point of view here is still of the corporation. Okay? So you have to imagine that you are this one. And you have to look for in the Securities Exchange Commission certificate or documents how many shares can you divide yourself and sell it to the public or sell it to someone. Okay? So if that is 100,000, then you can sell 100,000 shares to different people. Okay? And they will be called shareholders. Okay? And why are you doing that? You are selling shares in order to get money. Okay? You are getting money so that you can start your operations if you are still starting, or else if you are not starting already, you are already a matured corporation for expansion purposes. Expansion of operations like making branches and etc. You still sell shares. Okay? So here the tone is owner contributes. Here, the tone here is the corporation sell shares. The same substance. Okay? Sir, what is this par value? Par value is actually the limit, the minimum amount that you can sell one share for. So you cannot sell one share at 4 pesos because that is illegal. Okay? So you have to sell it at least 5 pesos. Okay? Sir, why is it that Mr. A purchased at 10, not 5? Again, this is just the minimum. This 10 might be the fair market value of the share. So the fair market value of the share is actually mandated by, not mandated, it's actually based on public trust in the corporation. So meaning, the bigger the trust of the public to the corporation, the higher is the fair market value, and you have to remember that. For example, if we talk about Samsung and Apple, of course, they are being trusted already by the public. It's because of their good products, good reputation, Tesla, something like that. So you are to expect that the fair market value of their shares is very, very big compared to their par value. Okay? So meaning, this fair market value of the shares, depending on public trust, can go down, can go up, can go down, can go up. Okay? Which is why the shares in the stock market are seemingly erratic. It goes up, it goes down, it goes up, it goes down. Something like that. Okay? So that is the explanation for this par value. This authorized number of shares, this fair market value, and the tone difference, but the same substance. Contribution, selling of shares here. Okay? So, what will be the entry counterpart if this is the the what do you call this? The transaction in the corporation. The entry will become like this. Still, debit cash. Alright? And then we will have ordinary share capital account instead of a capital, ordinary share capital account. But this ordinary share capital account is just limited to the par value. So what do I mean? You have 5 pesos only instead of 10 each. 5 pesos par value times 10,000 shares equals 5 times 10,000, that's 50,000. So it's not balanced. So there will be an entry, ordinary share capital, share premium as the balancing figure. Okay, so it's now balanced. Okay, so what did you notice? It's much technical here. The balancing figure is always, oh, it's a share premium. You need to remember that. It's much more technical. This is understandable. This is much more technical. But as you can see, there is a label here from the owner, A capital, right? So here, there's no label like that. Why is it so? In the sole proprietorship and the partnership, at least one of those will be considered as general owner. The general owner, if ever there are third-party creditors and they have a claim in the company and the company cannot pay, they will go after to those general owners, like the sole proprietor and the general partner in the partnership. So they could go to someone, it's because it's exposed, expressed in the books who are the owners. Whereas in the corporation, the owners are not seen in the financial statements. As you can see in the entry, you cannot tell that this is actually a transaction of A. Okay? And that is made like that because A can always sell his shares to another person. Unlike here, in the partnership and the sole proprietorship, you cannot sell your shares there. You cannot sell your ownership because the relationship, for example, between the partners is based on trust. Okay? So, if you are a partner A, you cannot immediately say that partner Z, you are the new partner, it's up to you. It's not like that. Partner Z can only become a partner if ever the other partners trust him. Okay? In here, you don't need trust. You can sell your shares to other parties without consulting with other shareholders. Basically, it's just like that. Okay? So, that's investment from owners. It just become technical. So, that's my point right there. As to profits or revenues or losses and expenses, we have a counterpart here in the shareholders equity, which is called the retained earnings. Wherein, if we talk about sole proprietorship and partnership, any profit or losses, revenues and expenses, the summary of revenues and expenses, will go immediately to the owners, to the sole proprietor, to the partners, right? It will be subdivided into the partners using their profit distribution scheme. In here in the corporation, since we do not have specific shareholders that are listed, it will go to the account retained earnings. Still, this is relatable. It is much more technical. And why is it called retained earnings? It's because all the earnings from the beginning of the corporation until now will be put here on the retained earnings. Whereas the profits and the revenues, the profits and the loss in the sole proprietorship and partnership, they are usually distributed immediately at the end of the year. Okay, so it will revert back to 0, 0, 0. It will go to the capital accounts of the owners. Here, the income and the loss, the revenues and expenses will also be 0, but it will be stored here in the retained earnings. Okay? We will talk about that in the later periods. Okay? Still, I'm in the comparison of shareholders' equity versus the capital in sole proprietorship and partnership. As to withdrawals, this is relatable. However, in the corporation, it will be considered as treasury shares for permanent withdrawal. Basically, treasury shares is actually if we sold 10,000 shares to Mr. A, so that's investment from the owner because we are giving Mr. A shares. He becomes a shareholder. Mr. A will give us money. So basically, Mr. A, since he is a shareholder, an owner, is giving him money, is giving us money. That's investment from the owner, right? Treasury shares is the opposite. We are going to take back the shares that we have given Mr. A, and we will give him money. Basically, it's a withdrawal, a permanent withdrawal. You understand? So, we're giving money to the owner back, and we're taking the shares. Basically, the substance is really withdrawal. Again, this is technical, more technical. This is more relatable. But it's the same in substance. Okay? And we're talking about permanent withdrawals here. What if we're talking about drawings? Drawings, that means the getting of the share of profits only. Like this is true to partnership. If the partner has a net income share of 100,000 and he withdraws that, that is considered as drawings or temporary drawings. Here, in the corporation, we also have an equivalent for the drawings. Again, drawings are withdrawals by the owners of their share of profit. Here, in the corporation, we have dividends. We're going to talk about that later on. Okay? So, that's the counterparts of these things. So, we have for profit or loss, we have retained earnings, we have permanent withdrawals, treasury shares here. We have temporary drawings, we have dividends in the corporation. An investment from owners, we have A capital, we have here ordinary share capital, share premium. So basically the same but more technical. The problem is, not only these accounts are present in the shareholders' equity. Actually, there are a lot of accounts on the shareholders' equity. Okay? So, you have to imagine at the end of this video, we're going to get the shareholders' equity in total based on those different accounts. That's our very goal. What is the shareholders equity? What is the shareholders equity ending balance if these are the transactions and these are the accounts? Okay? So that's our very main goal or end objective. Okay? For now, let's talk about this investment from owners. The entry is not just like this. Okay? So let's elaborate first the investment from owners. So the best investment from owners here in the shareholders equity is if the shareholders will pay immediately cash. Okay? So again, let's use Mr. A. Mr. A, Baby G Corporation. We are Baby G here. Baby G Corporation issued, how much was that? 10,000 shares, I guess. 10,000 shares for 10 pesos each. Right? Par value is 5 pesos. This is the best investment that a shareholder can give. Again, the entry for this one is that cash, 10,000 shares times 10 pesos each equals 100,000. Ordinary share capital, again, you still have 10,000 but you're limited at the par value. 10,000 times 5 equals 50,000. And ordinary share capital share premium, I would shortcut it already. We have 50,000. It's easy, right? So on the shareholders equity, you can put right here the ordinary share capital and OSC share premium. So in this case, that's 50,000 and 50,000. The point is, you already know that there are actually account titles, ordinary share capital share premium in the shareholders equity. Okay? Next, this is just situation 1. Issuance for cash. Sometimes, the shareholders will give you non-cash assets. Like for example, Mr. A, instead of giving 100,000 for 10,000 shares, he gave a land, for example. Land with a fair market value of 110,000. Of course, the fair market value of the shares is 100,000. Basically, I just copied here, 10,000 times 10, that's the fair market value of the shares. But the book value of the land is 10,000 shares already. Book value of the land is 90,000. And then the par value of shares issued is 50,000. So it's as if instead of contributing cash immediately, in the situation number 2, Mr. A has given you a land. You still have given 10,000 shares and Here are the details. The land has a fair market value of 110,000. The book value is 90,000. The fair market value of the shares that you're giving is 100,000. The par value of the shares issued is 50,000. Copied from here. The question is, what will be the entry? Okay? The entry will become land, of course. The question is, how do you value the land? Because the ordinary share capital, you already know that it is based on par value, 10,000 shares times 5 pesos equals 50,000. It was given here. Yeah. The problem is, if you do not know what is the value of the land to be recognized, then you will not get also the ordinary share capital share premium, the amount of the ordinary share capital share premium. So, according to the standard, I don't know if that is a standard because a shareholders equity does not really have a standard. That means this is being used by all the countries, even if those countries are not following IFRS and IES. Okay? So, what you are going to debit in the land, there is a first priority, second priority, third priority. Okay? Usually, if you are going to exchange something just like this, you you get the land and you give the shares. The basis should be the fair value of what you are giving up. In this case, since we are the corporation, we are giving the shares, we have to use the fair market value of the share supposedly. Okay? But this is an exception to that rule. Again, when exchanging something, you are going to give something and then you are going to get back another item. The recording of the new acquired asset or new acquired item should be based on what you have given up. Okay? The fair value of what you have given up. This is an exception, which is why we're not going to use the fair market value of the shares that you have given up. You're going to use the asset that you have received. So we're going to use the 110,000. And the ordinary share capital share premium will be at 60,000. That's the first priority. So in here, if you issue shares for a non-cash asset, the first priority is the fair value of the non-cash asset received. Why did I say first priority? Because if this is absent, you're going to go with the fair market value of the shares given up. So this will become 100,000 and this will become 50,000. So this is the first priority. And then the second. Sir, what if there is no fair value of shares also? Especially if we're talking about closed corporations. Closed corporations are corporations for specific individuals only, like family corporation. So since it is not open for the public, and especially if they are not seen on the Philippine Stock Exchange, there is no fair market value of those shares. So what if this is not present also? What will be the third priority? The third priority is the par value of the shares issued. So the land will become 50,000, the ordinary share capital will be 50,000. There will be zero OSC share premium. This is the third. Of course, the book value of the land. It means that is the recognized value in the books of A. We do not care about that. We do not care about the books of Mr. A because we are the corporation. Of course, this is not available in the actual. You cannot tell Mr. A, can we see your books on the land that you are giving us? Mostly, it will not be available. Okay? We do not care about this. So, if you see given like that, you treat it as a nuisance or flower. Okay? So, first, in the issuance of the shares for non-cash asset, you have to recognize the new asset at the fair market value of the asset received, and if it is absent, you use the fair market value of the shares issued, and the third one is the par value of the shares issued. That's it for the number 2. Still, we are not yet through because sometimes we are issuing shares to those people who have rendered services. Alright? Like for example, one of one of the lawyers helped you establish your corporation because again, the registering of corporations is a little bit tedious because it will not be really born if ever there is no approval from the Securities Exchange Commission and other government agencies. So you need a help from a lawyer or a professional. For example, let's go for CPA lawyer, for example. You talk to a CPA lawyer, and the CPA lawyer rendered 500 hours. The problem is, the CPA lawyer do not want to receive cash for his services. Let me check if it's still recording. Do not want to receive cash for his rendered services. Okay? He wants shares. So, what will happen? For example, the 500 hours is fair market value of services is 250 per hour. It's just an example. But let's check. How much was that? 500 times 250 an hour. Yeah, that's a little bit low, but let's stick to that. 250 per hour. And then the fair market value of the shares that were given up is still 100,000. And then the par value of the shares is 50,000. Because we're talking still of the 10,000 shares issued. Okay? So, what will be the entry? So, according to the standard, again, you have to record because the entry for this one will be expenses. Let's say on your chart of accounts, you have professional fees. Okay? So, under professional fees, and then we have OSC and OSC share premium. It's okay with the OSC. The OSC is still at 10,000 times 5. That's 50,000. The problem is the 2, especially the professional fees. Because the OSC share premium is just dependent on what is the amount on the professional fees. Okay? So, what will be the value of the professional fees? It depends on the fair market value of the services or fair market value of shares issued, whichever is more reliable. So if ever this is more reliable, based on the wordings of the problem that the lawyer is actually charging that 250 per hour, then we use this. So 250 times 500 hours, that is 125,000. So meaning this will become 75,000. But if the fair market value of shares is much more reliable, for example, the lawyer charged 250. There is no indication that it is more reliable. And that on the fair market value of shares, that is really taken from the Philippine Stock Exchange. So this will become more reliable. And this will become 100,000. And this will become 50,000. Okay? That is if the shares are issued for the services rendered. Okay? Now, it's not as easy as that still because we still have number 4. Number 4. Sometimes the shareholder will not pay immediately. He will just promise to buy shares at a certain price in the future. Okay? So that is what do we call a subscription. One of the shareholders, not yet shareholders technically, promised only or pledged to buy shares at a certain price. Like for example, if Mr. A said that, okay, I will buy shares after 3 months, I will pay 10,000 shares at 10 pesos. So what will happen? Upon the receipt of subscription or promise, you will have an entry. Subscription receivable immediately, which is another account of shareholders equity. So this is the pattern of our discussion always. It's the introduction of new accounts until we complete the possible account titles for the shareholders equity. Okay? So we have subscription receivable. And the subscription receivable is 10,000 shares. He will pay 100,000 for example. So that's 10 pesos each. Now, what is the entry for the credit? The credit is the subscribed share capital. The subscribed share capital account is actually very similar with the ordinary share capital. However, we cannot use ordinary share capital because it has not been paid for. You only use ordinary share capital share premium if ever, one, the shares has been fully paid for. And then second, there will be issuance of share certificate. Because upon full payment, there is a share certificate that will be issued to the shareholder. And since this is just subscribed, we put here subscribed share capital, not ordinary share capital, because again, there is no full payment yet, and there is no share certificate issued to Mr. A yet in this transaction number 4. So, it's the same with that because it is also at par. 10,000 times 5 is 50,000. However, you have to remember, OSC share premium is the balancing figure. There is no subscribed share capital share premium. Okay? It's only ordinary share capital share premium. Okay? We will talk about why is it called ordinary share capital, ordinary, the word ordinary, in the later episodes. Okay? But for now, let's stick to it. We have ordinary share capital share premium. So, that's the new accounts, subscription receivable and subscribed share capital. So, basically, I have to elaborate that sheet. On the first one, we have ordinary share capital, you already know that, and ordinary share capital share premium. Right now, you have another two accounts, subscription receivable. Subscription receivable is a shareholders equity account. However, this is to be deducted. These two, added to the shareholders equity balance, the subscription receivable is deducted. And as you can see, it has a debit, what do you call this? Debit normal balance. Okay? However, there is a twist. The subscription receivable will be transferred to asset if ever it is collectible within 1 year. So it's either part of the shareholders equity deduction or asset. However, they are both debits. The normal balance is debits. Okay? So that's one of the weird account titles here in the shareholders equity. Again, subscription receivable is just the promise of the shareholder. How many shares to how many shares um, will he get? Will he buy? Times the subscription price. Okay? Again, subscription receivable is part of the shareholders equity. It's a deduction, like a withdrawal, something like that, like treasury shares, as I've told you. However, it will become an asset. It will be transposed to asset if ever that is already collectible within 1 year. Okay? Now, the other one, the subscribed share capital, is the same with the ordinary share capital. It is to be added here in the shareholders equity. Okay? Now, for example, at the date January 1, 20x5, it's now 214, 20x5. Mr. A paid for 70% of the subscription receivable. So you're gonna receive debit cash 70,000 and credit subscription receivable 70,000. Okay? That's it. Sir, are you not going to make an entry like subscribed share capital will be transferred to ordinary share capital already because he has paid for already 70,000. That means 7,000 shares because 10,000 shares is 100,000. So it's as if 7,000 shares has been fully paid for. You're not going to do that. The subscribed share capital will still remain the same. It will still be subscribed. Why? It's because there is no full payment yet. So, it's as if on the 10,000 shares, Mr. A is only paying 7 pesos each. Okay? So, there's no full payment yet. Unless the problem says so. Like for example, on 21420x5, Mr. A fully paid 7,000 shares. If that is the case, there will be an entry here. The subscribed share capital will be closed. So from credit, it will be debited 7,000 times 10. No, 7,000 times 5 because in the subscribed share capital here, we use the par value. 7,000 times 5 equals 35,000. And we have ordinary share capital, 35,000. So ordinary share capital is used now already because the 7,000 has been fully paid, and this is used is as if you are making an entry like that because you are already issuing share certificate for the 7,000 shares. But then again, if it is not said in the problem that there is full payment for 7,000 shares, we are going to treat this as if Mr. A paid 7 pesos per share only for the 10,000 shares. So there is no entry like that. Okay? 315. 20x5. Full payment has been received from Mr. A. So what will happen? Of course, debit cash 30,000 for the remainder, and then subscription receivable 30,000. And since it's already fully paid, the subscribed share capital will be closed. So from credit 50,000, this will become debited 50,000. And you have to issue share certificate already. And you have to entry ordinary share capital already. It's as easy as that. Okay? Last twist for this video. What if the subscriber became delinquent? That means on the deadline, he did not pay. Example, On 2/14/20X5, he paid for the 70,000, but this did not happen. Okay? So what will happen now? What will happen now is that the shares that has been subscribed will be auctioned. Is this the... I don't know if that is the spelling. You will auction the 10,000 shares that was not fully paid. Okay? So you will find the highest bidder. However, in having this auction, there will be costs. For example, auction cost. 2,000 plus opportunity cost. What's opportunity cost? As you can see, Mr. A did not fulfill his promise. So he only contributed 70,000 out of 100,000. So meaning there is a deficiency of 30,000. When that 30,000 is so, if that 30,000 has been received on the deadline, it should be earning already. Because the corporations are made as a business. So meaning the capital of 30,000, if used, there is already an earning. That is what do we consider as opportunity cost. Since Mr. A did not pay for the 30,000, for example, there is a 500 opportunity cost. The supposedly earning of that 30,000 if it was contributed at due date. Okay? So, there is an auction cost, there is an opportunity cost. Um, BBG Corporation will find the highest bidder. So who is the highest bidder? The highest bidder that will pay for 30,000, the unpaid subscription receivable, plus the auction cost, plus the opportunity cost. Okay? Let's talk about entries later. Let's find first the highest bidder. So we have B, C, and D. These are the bidders. Okay? And the highest bidder, we have to determine the highest bidder still. So B wants to have 3,100 shares, while C wants to have 4,000 shares, while D needs only 3,500 shares. So meaning, they agreed to pay all of this, 30,000 plus 2,000 plus 500. That's 32,500. But they need this. Okay? So who is the highest bidder, logically speaking? The highest bidder is B. Alright? So, B will just receive 3,100 shares. And he will pay 32,500. Actually, they're going to pay the same 32,500, but they wanted a different number of shares as a compensation. Okay? So B is the highest bidder because he is to pay all of the things that we needed him to pay for the lowest amount of shares. So that's the definition of the highest bidder. Paying for the unpaid subscription receivable, the auction cost, and the opportunity cost at the lowest amount of shares. That is the highest bidder. Okay? So what will be the entry, sir, if we choose B? Before that, let's make an entry for auction cost and opportunity cost. So, when you incur this auction cost and opportunity cost, the entry will be receivable from highest bidder. How much? 2,000. 2,500. Actually, you're going to get those two from the receivable from the highest bidder. And then credit cash for the auction cost, 2,000. And then income of 500 for the opportunity cost. That means you still recognize income even though it did not materialize because of the late paying of Mr. A. However, it will become an income because it will be shouldered by the highest bidder. Okay? So when we selected the highest bidder, this will become the entry. First, you're gonna receive cash, The 30,000 plus the 25 equals 32,500. And then, you will have subscription receivable. You have to credit it, 30,000, the unpaid subscription receivable. And after that, we have receivable from highest bidder, which is 2,500. And then, the secondary entry is that the subscribed share capital will now be closed. A share certificate will be given already to A and B. A will be given 6,900 shares only because we are talking about 10,000 shares here. 3,1 will be given to B. 6,900 will be given to A because he still paid 70,000. So, subscribed share capital 50,000 and then ordinary share capital 50,000. But then again, let me emphasize, when you recognize or record ordinary share capital, that means the shares has been fully paid and that you are going to issue some share certificate already. Okay? So those are the entries. Okay? If we find the highest bidder, what if we cannot find the highest bidder? That is the fifth. The fifth is the Mr. A has been delinquent. The sixth is there is no highest bidder. Actually, there are 6 cases that we have talked about. We will summarize later on. Okay? What if there is no highest bidder? Why is it that there is no highest bidder? Like for example, B will pay 32,500 but he wants 7,000 shares. That's too much, right? There will be a problem because Mr. A paid 70,000. Of course, Mr. A will not take it lightly that he will only receive 3,000 shares because B wanted 7,000 shares. And the other two, C wants 10,000, D wants 12,000. 12,000 is out of question because what was auctioned is 10,000 shares. Right? So, this is wrong, this is wrong, this is also wrong. There is no highest bidder. Okay? So, what will happen? Is this gonna happen, this entry? Yes, because you will pay for the auction and of course, you have to recognize income also for the opportunity cost. Okay? What is just the change? The change is only the debit. The debit will become treasury shares. So it's as if there will be no cash that will be received because there is no highest bidder. You're still going to close the subscription receivable and receivable from highest bidder, but you are going to debit treasury shares. The meaning of the treasury shares, there will be share certificate, but it's in the hands of the corporation. Okay? So those are the shares of the corporation that is also in the hands of the corporation. Okay? You get it? So, you issue shares to yourself as if in the treasury shares. But don't worry because those shares can still be resold or reissued. Or it could be canceled or retired. Let's talk about treasury shares in the next episode so that you will understand what is the nature of treasury shares. But in the number 6 situation that we have, whereby we're talking about subscription and there is delinquency and there is no highest bidder, the only entry that will change from situation number 5 is the debit treasury shares. Okay? So let's summarize. We have talked about the investment from owners. The investment from owners in the corporation side is that issuance of shares to the shareholders. Okay? However, the to issuance of shares to the holders might be using different situation. Like for example, you issued shares for cash. This will become the situation. You debit cash, ordinary share capital for par value, and ordinary share capital share premium if there is still an excess. Sometimes you issue shares for a non-cash asset. And remember, if you issue shares for non-cash asset, you recognize the new asset at the fair value of the asset received. That's the first priority. If it is absent, you have fair value of the shares issued. And if it is absent, you have par value of the shares issued. Okay? It could also be uh, you are you are going to issue shares because of the services rendered by a shareholder. So what will happen? You recognize expenses, ordinary share capital, share premium. But the expenses that you have to put there, like for example, professional fees in our example, you have to base it on the fair market value of the services received or the fair value of the shares issued, whichever is more reliable. Okay? And number four, it could be subscribed first before paying. Of course, in situation number four, you are introduced to subscription receivable and subscribed share capital. Subscription receivable is, again, a capital account. However, if it is collectible within 1 year, it will be transferred to current asset. Okay? So subscription receivable is actually normally a deduction on the shareholders' equity. So subscription receivable will be deducted if ever you can collect from the subscriber. Whereas the subscribed share capital is the same with ordinary share capital, an addition to shareholders' equity. However, it should be marked as subscribed because it has not been fully paid for. Ordinary share capital will only be entered the if the shares that was promised is fully paid for and there is issuance of share certificate. So the subscribed share capital will just be closed if ever there is full payment already. Okay? Now, aside from that, if ever there is delinquency, what will happen is that the auction fees will be considered as receivable from highest bidder and the opportunity cost will be considered receivable from the highest bidder. Because in the auction, we are going to find the highest bidder. And again, the highest bidder is the ones that will pay for the unpaid subscription receivable, auction cost, and the opportunity cost at the lowest number of shares. Okay? And if you find that, you will debit cash, credit the unpaid subscription receivable, and credit the receivable from highest bidder. And the subscribed share capital, since it's fully paid, will be closed to ordinary share capital. But if ever, in situation number 6, if the highest bidder cannot be found, instead of debiting cash, you debit treasury shares. So that is actually a very good summary of what we've talked about in this episode. So again, we're going to talk about accounting for treasury shares in the next episode. So see you on the next one.